You know, I grew up not too far from here, over in Medford, and every year after Thanksgiving, I invite like 30 or 40 classmates over to the house that I went to high school with. And it sounds like some version of this room. So that's a really good sign. Everyone seems like they're happy to see each other. We're re-getting together. Quick introduction, I'm Mike Tucci. I co-founded Lexington Wealth Management with Christine Porcaro. Chris, can you raise your hand? There she is back there. There she is. And so, you know, we started the firm about 22 years ago. We thought we knew what we were doing. And maybe we knew a little something, but not as much as we probably needed to know at the time. But in spite of ourselves, the firm grew and grew, and we got some great clients, and a number of really talented people joined us over the years. And when we got going, we thought money went beyond two-dimensional, just risk and reward and whatnot. But we actually thought that really connecting with clients and really trying to know as best we can what's going on in real life. If we can understand that, we can bring other skill sets to the table and help solve for real life problems. Because life is not one linear spreadsheet going from here to there. Even if it does this, the road is undoubtedly rocky for all of us. Most of us, I won't say, all of us. So we have a little up here, it's connecting is the key element that we talk about. We really work really hard to connect. And when we were 3 or 4 people, we worked hard to connect, and now we're about 30-ish people, and we still work hard to connect. And I would say everyone that's joined Lexington over the years, the common denominator is just trying to do our best we can. We don't always get it right. We try our hardest. When we mess up, we try to say we messed up, move on, and try to figure things out. So we're big believers in a free market of ideas. So we'll have speakers up here tonight. They may say things that our investment committee may or may not agree with. But we don't mind that. We actually like that, right? And that's how we learn, because nobody has all the answers. So our goal tonight is to share some knowledge and perspectives. You may agree with some of it, you may disagree with some of it, but we love it. It's all part of the process that we really enjoyed here at Lexington. What we're going to do this evening is, the format is, Meera Pandit is going to speak from JP Morgan. She's a global strategist. So you've got only the world to cover, and you've got 20 minutes, so don't feel the pressure. And so she'll spend 20 minutes, and she'll give us her perspective. And then she and I will sit down and have a little bit of a hypothetical fireside chat, and we'll go back and forth a little bit, then we'll open the floor to you all, and you can ask questions, make comments, whatever you'd like, and go from there. And then Meera's got to hop a plane, and she's got to get back to New York City, so we're going to honor her, be out of here by 5 of 7 latest. Then Collin Martin's coming up from Schwab. He's a strategist at Schwab, working within fixed income. And now fixed income, for the first time in a very long time, is a sexy subject. Right? So congratulations, Collin, you're in the limelight now, right? Fixed income's finally like top of the heap. So it should be very interesting, and it should present a lot of great opportunities going forward for folks who are either near retirement or in retirement looking for a more steady stream of income in the future. I'm trying to take his limelight. So with that, Meera, you have the floor. By the way, one last thing I have to say to this, Meera, you're not going to like this.
Okay.
I got to say. So last Friday I was doing various Zooms. So I do Zoom one with our head of alternative investments. And there's a scene of Paris, and there's like French music playing. And he's dressed up like almost like a smoking jacket. I'm like, wow, this is really classy. Then we had some other client call. And then I had a call with JP Morgan. And they're probably amongst the most professional organizations we've ever worked with. Well, when we got on the phone, Libby, who I've known for a decade and a half maybe, she's dressed up as an 80s go-go girl. And Meera was dressed up as a bear market. So I'm not going to describe her costume, but I was like, am I on the right call? So here you go.
We like Halloween. Yeah, we do love Halloween, so. But thank you so much for having me this evening. Excited to be here. A lot has been going on in the market and the economy this year, and in fact, it's been very hard to distill it to just a couple of different themes. But we've tried to do that anyway, and I think that over the last couple of months, one of the themes that has emerged for us is that market cycles and economic cycles do not always tightly align. If you look back at history, what you tend to see is that markets typically bottom before the unemployment rate peaks, before we see earnings and profits reach their bottom, before we reach recession itself. And I think, it's fair to say we are likely, not definitely, but very, very likely heading into a recession at some point in 2023. And yet the sell-off that we've already seen this year in markets, whether it's bonds or stocks, is likely indicative of a lot of what's to come. And it's likely priced in a lot of what's to come. So we do want to keep that in mind because I think that from an economic perspective, we haven't experienced the worst of the pain in the economy. And yet from a market perspective, we've experienced a lot of the pain that we're likely to see. And when we see those types of resets in the markets and we see stocks and bonds become cheap again, that creates a lot of opportunities for the long run. Maybe not for the next few weeks or the next few months, but in the longer run, when you see that reset in valuations, it tends to typically imply pretty attractive returns over longer periods of time. So I'll talk about both of those themes this evening, and we can start off with thinking about growth, economic growth across the world. So coming out of COVID, we had a very, very strong economic expansion across the world. In the US, we grew 3 times as fast as we typically grow. So what we show here is this heat map of growth across the world. It basically looks at manufacturing and services activity in different parts of the world. So we kind of think of the colors like a lawn chart. Green is good, you want your lawn to have healthy green grass. Yellow, things are kind of dying out, things are slowing down. And then red, I never know what to say because I don't know where you live if your lawn is red, but that's like a very bad sign, I think. And what we're seeing now is a lot of yellow. We're starting to see some red in areas like Europe, but I'd say from a growth perspective, it's not equal across the board. We see areas like China continuing to stick to zero COVID policy. That has been a real challenge for their economy and growth. We see areas like Europe where they are facing acute energy challenges. That's hurting the consumer, that's hurting businesses. They are likely already in a recession. We're probably going to head into somewhat of a severe recession given the spikes in energy prices we've seen abroad. If we look at the US, things are definitely slowing down, but we're sort of still the best house on a bad block. The economy is cooling off after last year, but it's actually been a lot more resilient than we would have expected even just a couple of months ago. So broader global slowdown in economic growth. A lot of people say, well, technically we've had these 2 negative quarters of economic growth. Doesn't that mean we're in recession? And actually, technically it doesn't. And some of the swing factors in our economy this year actually haven't told us a lot about the health of the economy. Well, trade was very poor. Well, we've had a come down from the sugar high of government stimulus. Inventory growth has been slow. But those aren't the pillars of our economy. The real pillar of our economy is consumption. About 70% of our overall economy comes from different forms of consumption. So instead, we started to look at a couple of different measures that actually do tell us a little bit more about the health of the consumer and the economy. So we look at income, we look at spending, we look at industrial production. So what's the manufacturing activity? Are we producing goods? Retail sales, again, another measure of our consumers spending and buying things. And then most importantly, we look at jobs. And so we've created, again, another little heat map here at the top. And for the most part, we're still in the yellow zone. Things have slowed markedly, but things are still kind of hanging in there. Most notably, jobs. If you think about recession and depression, oftentimes people, the shorthand of the way they think about an economic downturn is well, if it's a milder recession, your neighbor lost their job. If it's a really bad recession, you lost your job. But this time around, we're actually seeing that we're still creating, month after month, hundreds of thousands of jobs. Now, that's probably going to slow, but think about it. If anybody is a small business owner, knows any small business owners, has been out shopping and seeing all these, for hire signs, we have a structural labor shortage. We don't have enough workers actually anymore. So the challenge is actually, if you have been trying to hire, you're not really going to want to get rid of people so easily. I don't want to let people go. So that is a really helpful factor when we think about the economy overall, that jobs are still intact. We're hearing a lot of headlines around layoffs. We are seeing that come through, but compared to many other periods in history, in fact, almost any other period in history, it's been a lot more contained. So that healthy jobs market has really been a great support for our overall economy. And again, the consumer is the worker is the consumer, so that's been overall healthy for consumption as well. Now, when the economy turns, it does tend to turn fast, and we've seen that the Federal Reserve is raising rates very quickly. That's making borrowing across the economy, whether you're a business or a consumer, more expensive. And the idea is to have a slowdown in some of that demand. The idea is that people are spending and investing less. And that's likely to be something that does lead to an economic recession at some point, perhaps at some point next year. So we're certainly monitoring a lot of these factors closely. But again, if you look at the bottom part of the chart here where we actually look at the last 6 months, things again, mostly growing, even though they're slowing, not yet stalling out. So something we'll watch pretty carefully, but that's why we don't think we are in recession yet. We could be there next year, but so far we're still in an okay place. Again, a lot of that does have to do with the job market and how strong that's been. So just to put that into context, what you can see on this slide here in the gray line is the unemployment rate over time. At 3.5%, we skirted those levels pre-pandemic, but you'd have to go all the way back to 1969 to see that kind of environment from an unemployment standpoint. Now, a lot of people say, well, people left the labor force during COVID, they're not coming back, that's the big problem. That's part of the problem. If we look at people who have actually come back to the labor force, you see people aged 25 to 55 actually mostly have come back. It's really kind of that 55 plus category. So in some ways that's been a long time coming when we think about demographics and retirement. So it's sort of a double-edged sword. On the one hand, again, you want to see most people have jobs and have the ability to have jobs and earn a living. On the other hand, the consumer is the worker is the consumer. So you put more money into the hands of the worker and they're going to spend it, and that's going to push up prices. So what you can see on that blue line there is we look at wage growth today versus 1 year ago. And if you look like kind of in the period post-financial crisis, the slope of that line is pretty gradual. Wage growth was pretty subdued. It was hard to get those pay increases. But more recently, post-pandemic, or in the last 2 years, I'd say, is you're really starting to see that pick up pretty meaningfully. Now, the reason why that is a concern from an economic perspective is, again, the more people chasing a finite amount of goods means more inflation. So it's inextricably linked to how we think about inflation and prices. That's why kind of the strong job market is, again, double-edged sword. Good that people have jobs, but as people spend more and more, that tends to fuel prices in the economy. So of course, that has led to, or is one of the factors that contributes to inflation at a 40-year high. So on this slide, we look in gray and in blue at two of the common measures of prices in the economy, the consumer price index. The blue line is all of the prices. That gray line is just a core measure. So it takes out food and energy just because those tend to be more volatile categories. But if you look at a lot of the different areas of inflation underneath the surface, we're actually starting to see things peak. It hasn't worked its way into the official statistics yet, but we're seeing evidence that price growth is starting to slow. For example, high food, high energy prices, those have largely peaked back in June. They're starting to come down a little bit. It's not necessarily going to be a linear straight line down, and I do think price levels are going to stay at higher levels for longer, but what you're starting to see is the increase in prices is starting to slow. If you think about hearing from some of the big companies across the US, take Nike for example, we have too many goods that people don't want to buy. Things are going on sale. That's broadly when we think about people pouring money into Pelotons and furniture and apparel in the beginning of the pandemic, starting to see the other side of that where people aren't buying the same things. If we think about supply chains, we looked at all sorts of measures of supply chain stress a year ago. Container ships waiting to unload, how expensive it is to ship things across the world, how long it takes to get our goods. We've really seen that roll over quite a bit, and it's really starting to normalize. Now, look, from a housing perspective, from a rent perspective, we're still seeing some of those areas high. From a services perspective, people are still spending on vacations, people still are going out to restaurants. But at higher prices, and I've experienced this in my own life, it's like, do I need to go out 2 nights or can I go out 1? Do I need to go on 2 vacations? Can I ratchet that back a little bit just because prices are getting a little bit more cumbersome to the overall budget? And all of that is disinflation. All of that is the slowdown in what people can charge. So while it's going to take some time for prices to come from high single digits growth down to something more like 2 or 3%, we think we can be on that journey. So we don't question the direction of travel when it comes to inflation. We do question the speed of how quickly we can get there, and also how much growth might need to be sacrificed in order to get there. So I think that's the general direction that we're moving in. But again, we're waiting to see this show up in greater measure in some of the official statistics and to start experiencing that a bit more in our day-to-day lives. So what can be done about inflation? Well, we can't do a lot about the supply issues. Food, energy, a lot of that is a result of some of the geopolitical challenges we're facing globally. War in Russia and Ukraine, big producers of fertilizer and wheat, obviously big producers of natural gas. So we can't control some of those things. But what we can control is, if we think about demand in the economy, how much we're all going out and spending on goods and services and housing. That's an area where the Federal Reserve, our central bank, can make some strides in trying to reduce some of that demand. Because if things get more expensive, borrowing costs for companies, for consumers, then people tend to start tightening their belt a little bit. I think mortgage rates is a great example of that. We saw mortgage rates, the 30-year fixed mortgage start at 3% in the beginning of the year. Now it's over 7%. That is a pass-through effect of the Fed. And that's why you're not seeing people show up to an open house and make an all-cash offer, trying to beat out 6 other people and seeing multiple bids on something that has doubled in price, over the last, 2 years or so. That's why you're seeing a slowing down in that activity. And that's the goal. That's what the Fed is trying to do. Again, take some of that heat out of the economy. So what you can see on this slide here is this is the federal funds rate. That's that key benchmark policy that really governs all of the other rates across the economy. Right now it is between 3 and about 3 1/4. Just for context, we started the year at 0. I mean, if you compare this to what we experienced after the financial crisis when the Fed began lifting rates, they've done more in the last 6 months than they really did over the course of 3 years. And they're not done yet. So they're very serious about reducing inflation. Now, it takes some time for higher rates to really feed into prices and make things work. But we've made a lot of progress in terms of getting rates up to a level that should start to slow price increases down a bit. Now, there's still some room to go. You can see that blue and that green line there, those dotted lines, essentially looking at where might the Fed have to go. The blue line is based on what the Fed's projection is. They think they could get to 4.6% next year. What the market expects is that they actually might get, just around there as well. Now, I think it's hard to really put a pin on exactly what the Federal Reserve is going to do going forward. But I think what is generally understood is that we're not quite there yet, but we're not that far away. So we're still watching carefully employment data, inflation data to see where the Fed goes. I think we're closer to the end of their hikes in rates than we are to the beginning, but we're not quite there yet. What we're really looking for into next year is the point where they pause and keep rates at a steady level. But what you can also see is that, look, the Fed has actually shifted their goalpost a lot this year. If we went back to October 2021, or I guess now November 2021, they said, maybe we'll raise rates once in 2022. You can see here that they've raised rates a whole 3%, so much more than what they thought this time last year. And sequentially throughout the year, the expectation of how much they need to raise rates has gone higher and higher. And of course, that has had a really stark impact on the markets. When we see rates move higher, we see bond prices fall, they work in opposite directions. So we've had one of the worst years in the bond market, basically ever. If we think about the equity market, we've seen a lot of volatility as well. But I think it's important to put some of this stuff in context, because we see headlines, we see things on TV, and it's, this is the worst month since, or this is the worst week since, or one of the worst days. Someone made a funny comment in a meeting the other day that's like, when you ride in an elevator, there's no soar button, there's no plunge button. You're going up or you're going down. So just the way that some of this gets kind of blown out of proportion can really affect our psyche and how we think about our portfolios. So what we show on this slide here is the S&P 500's calendar year returns in the bars, and then the red dots show the maximum the market fell in a given year. So this year we've seen the market fall at its worst about 25%. Right now, we're down about 18-ish as of Friday's close. And on an average year, we've certainly seen more volatility than a typical year, but even on average, if you look all the way back to 1980, we've seen the market sell off about 14% every year. So it's not unusual to see a double-digit decline. This is certainly a little bit more than we typically see. But what we've also tended to see over time is for investors who have suffered the sell-off, they are often, eventually, rewarded with a rebound. So you can see there too that in 32 out of the last 42 years, calendar year returns ended up positive, despite some of these falls in the market. Now, is that to say this year's calendar year will be positive? I mean, given where we are today, probably not. I think we need to see a couple of different things happen in order to start to see markets turn around. Namely, I think we need to get a little bit more clarity on where the Fed goes and where the Fed stops. And I don't think we're necessarily going to get that this year, despite some recent rallying in the markets. But do I think over time we will recover? Absolutely. The S&P 500 has never failed to regain a prior peak and then surpass it. So it's probably not going to happen this year. Might not happen next year. But I do think over time we will get that rebound. Now, I think we're used to markets moving quickly, and specifically post-COVID, where you saw very little market sell-off last year. Market fell just 5% and was up almost 30%. We're sort of out of practice with volatility. You can also see just like the staggering returns that we've gotten prior to this year in the last 3 years. Like, it was more likely than not that you were going to see almost a 30% return. So it's really unusual, the experience that we've had in markets. So I think in the longer run, we have to put this year in a little bit of context. But what I'd also say is, let me come back to that. What I'd also say is if we think about how we feel in this environment versus what that tends to tell us about the investing environment, they're often exactly the opposite. Consumer sentiment, how we feel about the economy and markets, actually tends to be a bad indicator for investing. So what we can see on this slide here is we look at the consumer sentiment index back since the early 1970s. So the top's there when people were feeling their absolute best, the bottom's there when people were feeling their absolute worst. And we're coming off of the summer where people felt their absolute worst, as in their absolute worst in the last 50 years. Like worse than the height of COVID, worse than when US debt got downgraded, worse than the financial crisis, the tech wreck, any other period back since 1970. And yet, when we overlay investment returns here, what we tend to see is, again, the exact opposite investor experience. If you look at the average across the bubbles in blue at the top, when people were feeling their best, 1 year later, returns on average were about 4%. If you look at when investors are feeling their absolute worst and all the bubbles that kind of skirt the bottoms, those lows in sentiment, 1 year later, returns on average were nearly 25%. So again, not to say we're going straight up 25% from here, but I think, again, the psychology is really important here. We think like, oh, being an investment advisor must be super easy because you just buy low and sell high. Like, no big deal, right? But how do we feel when we actually get to those points where you can buy low and sell high? We usually feel the exact opposite. So I think being disciplined in this environment about what we're looking for from our investments, understanding how they should perform in different environments, and making decisions based off of those types of criteria embedded in our investment plan is super important. Speaking of feeling emotional, feeling revved up about markets, this is always a bit of a tricky time of year because we have elections upon us. And I think the number one advice we like to give clients when thinking about investing during elections is don't let how you feel about politics overrule how you think about investing. So what this slide here shows is, again, consumer sentiment about the economy. So what you can see here is percentage of Republicans and Democrats, and in red and blue here, who rate national economic conditions as excellent or good over time. And it's a pretty clear pattern. If you are a Republican during a Republican presidency, you feel much better about the economy. If you are a Democrat during a Democratic presidency, you feel much better about the economy. And again, when you overlay investment returns, that's not really the case. What you actually saw during the Trump administration and the Obama administration is almost identical annualized returns on the S&P 500. of about 16%. And over the last 30 years, you saw average returns of about 10.6%. So different administrations, different approaches, and yet we saw very similar, almost identical investment outcomes. So I think that's really important to consider, that we shouldn't be investing based on, I like the people in Congress or I like the people in the White House, because there's a whole lot that drives markets. Policy is a piece of it, but it doesn't necessarily determine what the outcomes are. Generally, when we think about investing around elections, we always tend to see volatility in the lead up to elections, because it's a form of uncertainty. But as soon as we clear elections, regardless of the result, what we've seen over time is that markets tend to take off. Markets took off after the 2016 election. Markets took off after the 2020 election. And again, different results, different outcomes, different environments, and either way, markets were just happy to move on from that environment and focus back on a lot of the different fundamentals that are impacting returns. So let's think again about, if we are able to recover in this market over a certain period of time, what do returns look like going forward? Because again, I mentioned that when you see a reset in valuations, when you see a reset across stocks and bonds in terms of prices, it tends to actually bear a lot of fruit over the longer run, over a multi-year time horizon. So again, let's not get too excited about the next few weeks and months, but if we think about multiple years and what we could stand to gain in the rebound, things actually look attractive going forward. So what we take a look at in the chart on the left is we say, okay, so if we do get back to that high in the S&P 500, at some point, what would our returns look like on the way back up? And what you can see there is, basically, if it took 3 years for the S&P to get back to its peak, which I think is fairly conservative, maybe next year we have recession and things kind of move a little bit sideways, takes a little time to recover. Let's say it takes 3 years' time. You'd be looking at an 8.9% return each year on the way back up, just mathematically to get back to that peak. If you're thinking about shorter periods of time, I think market could come back shorter in a shorter period of time than that. It's potentially double-digit returns on the way back up. So we've already, again, suffered that sell-off. It's not a great time to bail, especially when we think about what could happen on the other side. That does mean we need to be patient. That does mean we need to be a bit disciplined. But what we stand to gain on the other side could be pretty attractive, going forward. And in that vein, how do we generally think about investing during times like this, where there is a lot of uncertainty and there are a lot of challenges? We tend to think, let's be a little bit diversified. And I know that sounds boring, but it's really hard to make a big bet in this environment. I want to put a lot of money in here. I want to be overweight to this because there's so much uncertainty. There's a lot of competing factors, and there's a lot that's changing. So this is the time where diversification gives us a plan when it feels like there's been a lot of uncertainty and a lot of different challenges. So what this shows is the benefit of being diversified and also having that longer term time horizon. So what you can see on this slide here is a range of stock in green, bond in blue, and then in gray 50-50 portfolio returns back since 1950. And we look at them on rolling periods. So a rolling 1 year, 5, 10, and 20 years. So just for instance, if you invested in the stock market in green in any 1 year back since 1950, you could have had a 47% return. You also could have had a negative 39% return. So huge range of outcomes. And when we're thinking about getting those statements year after year, that's not the kind of volatility that we want to see. So when you add a little bit of bonds to that and look at that diversified portfolio in gray, you can see your outcomes compress. 33%, negative 15%. Again, that's still a pretty large range. But when you extend out that time horizon, what you tend to see then is not only does that range compress pretty dramatically, but it also, especially in gray, that diversified portfolio overwhelmingly skews positive. So again, simple example, just looking at US stocks, US bonds, your actual portfolios are probably a lot more diversified, but that is why we say be diversified and be patient, because the antidote to volatility is diversification in time. A lot of times people think volatility is the portfolio killer. But volatility is a feature, not a flaw within the market. It can present a lot of different opportunities, and the best way to smooth it out over time is not necessarily to try to trade around it, try to get it in and out. That tends to be a poor strategy. Now, I will admit, And final slide here, I will admit that diversification has been really challenged this year. I would be remiss not to acknowledge that both your stocks and bonds are down this year. And that's very unusual, and it's very painful. But it's not entirely unprecedented. So what we show on this slide here is a similar version from the slide a few slides ago on equities, where we actually look at a 60-40 portfolio. Equities in green, and then fixed income in gray, and it adds up to that calendar year return each year. But we can also see the sell-offs in given years. And we've had a double-digit, pretty heavy double-digit decline in the 60-40 portfolio this year. It's rare, but it's not unprecedented. We've actually had 9 other occasions back since 1980 on this chart where we've had a decline within a given year of more than 10%. And in 8 out of those 9 instances, we actually saw the following calendar year end up positive to the tune of about 17% on average. And a lot of that has to do with when valuations of stocks and bonds get crushed. We still remember that we're investing in good American companies or good international companies with strong balance sheets. That's what we're certainly gearing towards. So ultimately, we're probably going to see a rebound at some point. We have to be patient for. So this is kind of the impact of waiting out and riding through some of that volatility when we get to the other side. The bad news is that both stocks and bonds did very poorly this year so far. The good news is that that does reset on both ends of the spectrum for where we could be going again over a multi-year time horizon. I think this is the worst time to give up on diversification because let's say we do see a recession in 6, 9, 12 months. That's a time where bonds tend to protect in portfolios. It's a time where equities could still have some challenges, but all of a sudden you're probably going to start to see that yin and yang in portfolios where different things work at different times. You come out of a recession, that tends to be a time where maybe bonds are less attractive than equities because equities are really rebounding. So I think that give and take from both sides of the portfolio is going to also start to come back in the future years. But Mike, you come on up and chat. Yeah.
Can you all hear me? 1, 2, 3, testing. So thank you very much. Really good, really informative. So I'm going to throw a couple questions out, and I'll turn it over to the group to ask some of their questions. And we have probably 10, 15 minutes. Let's talk about China for a second. So Xi Jinping was just elected to a third term. Totally up and up election, but he's in there for a third term. And China's stock market took a really deep dive. And many are questioning now whether China's investable. And the question which comes up is China's the second biggest economy in the world behind that of the US. What do you think? What do you think is happening there, and what do you think the future implications are?
So I think in the short term, there's definitely a lot of uncertainty around China because I think that from a regulatory perspective, when we think about stocks that don't necessarily trade domestically within China, there's some challenges to some of their tech sector. People wonder, okay, how's the relationship between the US and China going to impact stocks? The zero COVID policy is certainly a challenge to growth. The property sector is kind of slowly bleeding out. So there is no shortage of headwinds in China right now. Do I think that they have the policy tools to deal with things like the property sector? I do. The challenge is when you try to stimulate the economy from a monetary angle or a fiscal angle, but you have the zero COVID policy where there's a lot of uncertainty around the economy's open, the economy's closed, this place is closed, this place is open. A lot of that policy cannot work as effectively. So I do think that the zero COVID policy is a big swing factor. I think what could change that if China had develops or partners with someone in the international community on more effective vaccines. I think their big fear is we have an aging population and the vaccines, frankly, are not known to be as effective as certain ones that we see in the US, so they really worry about their healthcare system. I think if we do eventually start to see them easing up on that a little bit more, that could really help. Now, China, from this perspective, is not entirely bad from a global perspective, even though it's a slowdown on global growth. On the other hand, if China's growing a lot, that means commodity prices come up. That means actually we see more inflation across the world. So China in this environment has actually been somewhat disinflationary compared to what it could be if it were growing quickly and recovering in the way other economies have been able to do. So I think from a shorter term perspective, there's still a lot of headwinds and there's certain catalysts that we're waiting for that we don't have a good timeline on. But I think in the longer run, in terms of whether China is investable, again, it's the second largest economy in the world, so I don't think we want to lose sight of how prominent it is within the global world order. I think it's how you invest in China. And policymakers are very specific there. Maybe areas like the old technology, things like e-commerce, are things that they want to put more regulation around, more reform. They don't want that to become the next property sector. They want to grow really for quality as opposed to quantity, and I think that's why you're seeing so many reforms in different areas. But if they want to be the largest economy in the world, they have to make some big bets. And they're making big bets around things like green technology. They're one of the preeminent producers of electric vehicles in the world. They are doing massive amounts of solar, wind, battery production. They basically own a lot of the supply chains around the world for those key commodities. Robotics, AI, growing consumer. So I think the way we think about it is very much, let's pick the themes that we like, let's align with some of the big bets that they're making for the long term in terms of growth, and that's how we think about investing in China. Yes, from a sentiment perspective, there's a lot of headwinds. That's why we don't want to be too passive in the market. But I think that there's a lot of longer term opportunities. It's just, again, really thinking time horizon in perhaps a different way than we might for other regions.
Okay. Toggle over to geopolitical risk. Right? It seemed for a long time, geopolitical risk were always talked about, but they were just kind of thrown out there and people have moved on. At one point it was the US, USSR, then it was just the US. And now many are looking at it as the US, USSR, China, and the EU. And there's a lot of talk of onshoring or friendshoring, where you bring back production to countries that are friendly towards you. And a couple of implications, one of which is that before, with globalization, it was deflationary. And perhaps this friendshoring or onshoring is going to become a little bit more inflationary as we move on. And the Fed may have to settle for a higher inflation rate than 2.5%, maybe it has to be 3.5% or 4%. I guess your thoughts?
So I guess a couple of things. I think there are limits to deglobalization. I certainly think we're seeing it on the margins, but we had actually chatted about this earlier today where
we had lunch together, so it's a long day for you, I'm sorry.
So one of the things that we talked about was the fact that there was a great survey that came out last summer from the Chamber of Commerce American Chamber of Commerce based in Shanghai. And they did a survey of local businesses onshore in China from the US and basically said, to what extent are you planning to move your supply chains away? And it wasn't a yes or no answer. They would give kind of gradients of like, to some extent, X amount, whatever. And 72% of respondents said not at all. And I think what that underlines is the fact that, one, for companies, inexpensive labor is really important. If we think about the labor advantage from a China perspective, 20, 30 years ago, labor was 30 times cheaper. Now that's actually collapsed to about 4 times cheaper. But still, 4 times cheaper when you're a company and you're thinking about your profits is meaningful. So from a profits perspective, I think it's going to be a challenge for companies to actually bring a lot of stuff back onshore or bring it away from China itself. The other issue is scale. Even if you can find cheaper labor in different parts of the world, if they don't have quite the scale in terms of the know-how and the ability to do that, that's going to be a challenge too. So I think that while it's very popular, the idea and the thinking behind friendshoring, reshoring, from a cost perspective, it's challenging. And this is against a backdrop where profits are already facing a lot of pressure and headwinds. So I think it's going to be a bit of a challenge to do that. But I do agree that, look, one way or the other, it's going to be a little bit more inflationary as people are trying to protect their supply chains a little bit more and doing some of this on the margin. And I think there's a number of things, whether it's deglobalization or slightly less globalization, higher debt and deficits, higher wages because of labor shortage, that is going to keep inflation closer to 2 to 3% as opposed to below 2% that we've been experiencing over the last 10 to 15 years.
One last question, and I'll turn it over to all of you. So in our world, there's something called the 60-40 portfolio. People think of it as 60% stocks. Most of the world thinks of it as US stocks and 40% bonds. For many, many years, Lexington's looked beyond that and has included all kinds of different kinds of stocks, and different kinds of bonds, and some alternative investments or private vehicles. What are your thoughts about the future of investing for folks who've done well in life, but then are a pension fund and they've got liabilities and are trying to take care of families?
So it's been a challenge because, inflation might not necessarily impact younger people as much as people who are retirees, where you're actually drawing down on your portfolio. So we definitely have that question a lot. And I think about it in a couple of ways. One, we have seen Social Security benefits for next year resetting to a higher level. So to some extent that is tracking with inflation when we think about that cost of living adjustment up 8.7% next year. So there are some ability to kind of hedge, I'd say. The other thing is, yes, we think about our total portfolio, our total net worth, and we see some of the challenges that have happened to portfolios this year. And some people say, my time horizon is not 5, 10, 15, 20 years. But at the same time, you're probably not spending every dollar you have every day. You're spending a portion of that. So I do still think that portions of people's portfolios are still quite long-term in nature, because it's supposed to still last you through retirement. So I think a lot of portfolios can still recover over time and have the opportunity to do that. Yes, we're still using our portfolios for income and supporting our lifestyle, but if we think about that percentage that we're actually using versus the pile that we have that's going to be allowed to recover, maybe we should feel a little bit of solace in that, because I don't think we're going to be in a multi-year time horizon where we're having 8% inflation. I do think things will come down pretty meaningfully next year. I do think that, given the reset in valuations, we do have some time to see a turnaround in things over time. So again, bit of diversification between stocks and bonds. Things like alternatives have definitely worked their way into portfolios more prominently, and a lot of those can seek to achieve some of the outcomes that you feel like maybe the public markets aren't, whether it's income or diversification or return enhancement. So I think we have a lot of tools. We just have to be a little bit more creative, because a plain vanilla 60-40 since coming out of the financial crisis would have given you an 11.5% return. I don't think that the environment is going to be as easy as it was over the last 10 to 15 years from that perspective, so we have to kind of pull on more levers going forward.
Perfect. I'm going to pass this to you to hold, and
Okay.
I'm going to run the microphone to whomever would like to ask a question. Well, Adam, come back. This is the guy I want you about. This one.
My question's about financial modeling and real returns. So one of the concerns I've been worried about is inflation tracking above, the 3%, and a lot of financial models are built on that. So if nominal returns of a diversified portfolio, say, give 8 or 9, but then the CPI gets up to 5 or 6, so then the real returns really compress, and we don't see the return. So I was really wondering how you're thinking about, you talk about a lot of these nominal things, but how it translates into real returns that go into people's back pockets.
Yeah, so I think that, it may be a little bit different on a go-forward basis when we think about the equity markets versus the fixed income markets. I think that going forward, especially once we see inflation kind of getting into the 2 to 3% range, and I do think that's a realistic expectation in the longer run, that you might have a positive real return on the equity side, but from a bond side, it's going to be a little bit more challenging. Because I do think, while you could see inflation, again, 2 to 3%, I think that you're not going to see yields, on bonds, massively higher than that. So I think it's still going to be a little bit of a challenge on a go-forward basis to get meaningfully positive real returns. We have been low inflation, low yields over the last 10 to 15 years. I think we could be in sort of medium inflation, slightly higher, but also slightly higher yields. So I think it'll be a little bit more of a challenge on the fixed income side, but I think that from an equity side, we can still get decent positive real returns on a go-forward basis. But again, it's going to mean leaning on things like alternatives for other outcomes as well, and again, being kind of creative in our portfolio construction.
Okay, we're going to take one last short question, because Meera has a plane to catch, and Lexington, well, does not have a jet. Who's got a short one? I saw this gentleman here first.
Thank you. Mike's question about China just had me thinking, Meera, this is more of a philosophic question. Where does ESG fit into all of this? There's a lot of controversy around that right now, and I have romantic notions about how capital can make a difference around these issues. Can you just comment on where that's going and where it has any impact on going forward?
Sure. I think that ESG has definitely been something that has become very politicized, but the way I think about it is two ways. If we think about our portfolios and how we want to assess our portfolios, a lot of times we want to mitigate risk. What ESG does is essentially it gives you more data to think through. Some of the areas that traditional financial modeling may not capture. Different factors like environmental, social, governance, risk. Take it or leave it, but that's just more data for us to invest and for us to assess our investments on. And it can mean different things to different people. People can prioritize different elements. It's highly customizable. So I think about it as another tool in the risk management toolkit. The other way I think about it, and I don't think you can necessarily get the risk management side and the growth side in the same way, but I think about it in terms of opportunities for growth. We have a growth portfolio manager that looks at the top 10 companies by decade, every decade for the last 50, 60 years, and they're always different. And I think if we look at the top 10 companies of 2020, and a lot of them are some of the big tech companies, what we've already started to see is that I don't think that those are going to be the market leaders over the next 10 years. So what kinds of technologies are going to make a change? When it comes to the corporate side, I think the train has left the station, where you see massive investing in different types of renewables, solar energy, batteries, health technology, wearables. If we think about needing to early diagnose diseases and have more tracking, democratize healthcare, that's a big piece of that too. A lot of this comes back to innovation and technology. So is that going to be a growth area? I think so. Is a lot of it sort of in some of its nascent stages? I also would concede to that. So I think about it in those two spectrums. Differentiated opportunities for growth, differentiated opportunities for risk management. You can kind of take it or leave it, but I think that there are interesting frameworks to use when we're assessing opportunities going forward.
Thank you, Meera. Thank you, Meera. Thank you, JP Morgan team. JP Morgan's been great partners with us for several years, and we're great thanks for. So speaking of great partners, Collin is coming in from Schwab. Over the years, Schwab it's been a custodian of ours, but they're also a partner that's helped us with many things. In the past, for those of you that have been around for a long time, we've had the chief strategist, Liz Ann Saunders, who I think is one of the most brilliant people in and around Wall Street, and she can talk to anyone, and she's really, really on top of things and entertaining. As well as Jeff Kleintop, who's the global strategist, who's been an invaluable resource to us here at Lexington. So I definitely want to thank our partners at Schwab, who have been unbelievable. Tonight we're really honored to have Collin come and speak on fixed income. And fixed income is in the headlines this year. There's a lot to talk about, a lot to think about. So without further ado, here's Collin.
Thanks, Mike. Well, Lizanne and Jeff aren't here, so you're stuck with me for the next 45 minutes. But I will do my best to hopefully just educate you about the bond market. I think it's something that a lot of investors have a lot of questions about. It's something that most investors should own. Personally, I think a lot of people should own more bonds, but I understand the sexiness of stocks, although Mike highlighted that bonds are sexy now. But what I really like to do, and I love events like this, is to just educate and explain the nuances of what's going on. So especially this year, what happened this year? Do we think it can get worse? And most importantly, what does it mean for you and your portfolios, and how can you build your portfolio around the events we saw this year? So I'll start with what happened. And a lot of my slides, it's going to tie in well with Meera's points before, but luckily I have some similar slides, but slightly different. And I don't think there's any overlap, so it's really nice that I can kind of touch on some of her points. This is one of our favorite charts to show, and this is a long-term look at the performance of the bond market. The index we use, the benchmark for the bond market, is the Bloomberg U.S. Aggregate Bond Index. It's high-quality bond investments. It's U.S. Treasuries, it's investment-grade corporate bonds, and it's mortgage-backed securities. Since its inception in 1976, it's only had a handful of negative returns. But if you're a bondholder this year, or if you're not and you're watching the news, clearly this year is an anomaly. we had to change the axes on this chart and really just change our talking parts. We used to have a joke that a bad day in the stock market was a bad year in the bond market, but we can't use that anymore. But I will say one thing. I agree with almost everything Meera said, but I am a bond guy. And she showed the chart that what we're seeing this year is somewhat normal, because she looked at those intra-year declines of 10% or more. It wasn't the bond market's fault. This year it is. And also, one more thing, because I'm a bond guy, there's a lot of concern, as Mike alluded to, and I'll talk about this, the 60-40 discussion, right? Bonds are meant to help offset some of the risk in the equity markets. This year it hasn't been the case. So there's all this talk about, well, why should I be in bonds? It didn't help this year. Well, I say, well, why didn't stocks help offset my bond losses? All right, that's it for now, and I'll focus on our outlook. But this is what has normally been the case with the bond market, and this year, unfortunately, it hasn't been the case. If I step back and just kind of explain what bonds are and why this happened. So bonds are a debt obligation. You're lending to a government, a company, a municipality, and in exchange, they're going to pay your money back after a certain period of time, and they're going to give you interest on that money. But if interest rates rise in the secondary market, the price, the value of your bond holdings falls. And a good example, luckily I was chatting with someone in the cocktail hour and kind of walked through this. Let's say you hold a CD or a treasury with a 2% yield. Well, we saw yields rise this year, and now you can get the same maturity CD or treasury with a 5% yield. I'm not going to want to buy that 2% yielding security from you. The only way I'm going to want to do that is if I pay a lower price. So there's an inverse relationship with prices and yields when it comes to the bond market. So rising yields can be a good thing if you're looking to invest, if you're entering retirement, near retirement, in retirement. We're seeing some of the highest yields we've seen in years. But it hasn't been a good thing if you're holding bonds, as this chart shows. Now the why, and this also plays on the chart that Meera just showed. We looked at the past handful of Fed rate hike cycles, going back to, I think, 1980. And what we're showing here, it's not the actual rate, it's the months from the first rate hike, and then the actual percentage point change. So what you can see here on the left, where you can see this cycle in dark blue, it's not just the amount that they've raised, which is at the high end of what we've seen over the past 40 years, it's the speed. And if we look at the line closest to it, the cycle of 1994, they've essentially hiked by the same amount in half the amount of time. We've already seen 3 percentage point increase in the Fed funds rate, and that's lifted yields everywhere higher, and that's why we've seen returns perform so poorly this year. Now this is actually going to keep rising tomorrow. The Fed is meeting today, they finish their meeting tomorrow. It's widely expected that they'll hike rates by another 0.75%, so that'll get that cumulative change to 3.75%. That doesn't mean that all of your bond holdings are necessarily going to fall tomorrow. It also doesn't mean that you need to wait for them to keep hiking to invest in the bond market, but I'll get to that in a little bit. Another chart to talk about the stock market and the bond market and the whole 60-40 discussion to kind of highlight how much of an anomaly this year is this chart that we just recently put together, and now that I see it, we should have made the bottom bars a little bit darker, because I'm sure you can't see that. On the bottom here we have, those are very, very light gray columns, and they're sorted from left to right in rolling 12-month returns for the S&P 500. So all the way on the left, you see roughly 45% column, if you can see that. And if you go all the way to the right, these are all of the 12-month periods going back to, I think, the 70s, when the 12-month return was negative. For the most part, you can see those green columns up top, that's the return of the bond market, an intermediate term index of bonds. And for the most part, usually bonds perform well when the stock market's declining. We did highlight a handful of the instances when the bond market declined sharply as well. Most of those are this year.
One of the things that I find challenging about bond investing is that we often refer to these indices, right, as the reference point, but the experience of a bond investor who owns a portfolio of individual bonds is quite different, right? So One of the questions is about unrealized versus realized losses in bonds. And then secondly, your view on tax loss harvesting in bond portfolios and whether or not you think that's appropriate.
It's something we've talked about, but the problem is there's a lot of losses out there. So it's not just the bond losses, but sure, if you have gains elsewhere, fantastic. But in the bond market, yeah, absolutely. Just like in any investment that you have, we think you could tax loss harvest and then find an opportunity that makes sense and with the yields we're seeing now. Your first question is yeah.
So Lexington, we like to harvest losses, even if we can use them against current gains, but we can also carry them forward into the future. And we've got Tom Goodwin, CPA, out here if any of you want to lay deeper. So.
And if there's a Schwab compliance person in the room, I'm not providing tax credits. Very strict about that. And you don't want it from me either. But your first question is an important one, and we have a table that I sometimes include, but the question's about, it's essentially holding individual bonds versus a bond fund, I guess, to a degree, right?
Or a bond ETF.
Or a bond ETF, right?
Yeah.
So, because if you have a bond fund this year, chances are it's down. Most are down. There's very few that are up. And the bad news is if you're in a bond fund, whether it's a mutual fund or an ETF, it's not guaranteed to accrete back to whatever price you bought it at or whatever it was at a month ago. Because if the fund manager is actively managing a fund, and let's say they're targeting specific maturities, and they're selling some now, they're essentially locking in that price and that value and then buying new ones, and we're not necessarily going to get that accretion back up. That doesn't mean it's all bad news though, because the bonds they're buying have higher yields. So even though you don't get that appreciation back to whatever value it is you're looking for, you should be rewarded with higher income payments, which isn't the case with individual bonds. Now, if you hold individual bonds, but in this environment, chances are your individual bonds are down just as much as a fund would be. I mean, what's a fund except a portfolio of individual bonds? But you have that light at the end of the tunnel. You have a guaranteed maturity date, and you know when you're going to get that money back and how much you're going to get back. So when you're considering which to invest in or what's better or worse, there's no better or worse in our view, but I think it comes down to your investor psychology and how you want to think about it. If you want, a guaranteed maturity at a certain date, then individual bonds are probably the way to go. But you have to build, it's difficult to build and manage a portfolio yourself. If you're looking for low cost access and tons of easy diversification, then a fund makes sense, and you just have to trust that over time you're going to be rewarded with higher income payments. And one final point, I'm probably rambling on. There's a study out there that addresses this exact question, where if you buy a bond fund, whether it's a mutual fund or ETF, and it targets an average maturity, if you hold it for that duration, that time, your annualized average return is going to be very similar to what the yield is when you invest in it. So let's say today you bought a fund that held mostly 5-year bonds and had a 5% yield. If you hold it for 5 years, because that's the maturity they're targeting, regardless of what happens with interest rates, your annualized average return is likely to be that 5% yield. Because if yields rise, you're going to be rewarded with higher income payments. If yields fall, you get price appreciation, but then lower income payments. Sorry, wonky response.
No, please, that's great. Other questions? Yes, well, microphone's coming over.
My name is Svetlana. I have a quick question. Imagine if tomorrow war in Ukraine stop, Putin dead, what is the effect of this economics in US?
Oh.
Inflation and bonds, all that.
Yeah, well, I'll give the easy answers. I think it would be great for inflation. I think that's the number one concern, and that's been a huge driver of inflation, more so in Europe than here. But if that were to happen and we can get energy flowing the way it was, I think that's a huge positive for the inflation outlook, because that can bring oil prices down and gas prices down. I also think it would be positive just from a a psychology level. I mean, that's a risk out there. Geopolitics are always a risk, but this is a pretty big risk right now. If we can sort of neutralize that, I think it takes one unknown out of the equation. It wouldn't solve a lot of things. I mean, in the U.S., it's not like we'd see inflation go back down to 2% in the next few months. It also might not help our economy grow much more in the near term, but I think all of those external factors over a longer period of time, whether it's a year or two, I think would be an overall positive.
Questions in the room? Let's go to someone besides Kimberly for a second. Right here in the back.
Hi, Collin. I appreciate your comments about the impact of inflation on bond performance. What about credit quality, which is also another factor that influences bonds? Are you seeing signs of weakness in companies, in municipalities, et cetera?
Not really in municipalities. For the most part, with the municipal bond market, municipalities are in pretty good shape. Their revenues are much more stable. And while there might be some pockets here and there, that's really not a concern of ours. We do have growing concern about the taxable corporate side of the equation. You know, I mentioned before that we're still comfortable with investment-grade corporate bonds, but overall, the environment we're in is really not good for corporations. You have supply costs rising, you have labor costs rising, as we know, with wages going up so much, and now you have borrowing costs rising. And that's a risk for any company that needs to issue debt right now or refinance debt right now. It's kind of the triple whammy of rising costs in an environment that's expected to slow, right? If economic growth slows, it's likely that corporate profit growth slows at all. That's a pretty negative picture. Despite that, we're still okay with investment-grade corporate bonds. There can be some volatility, but it's not like the investment-grade corporate market's going to suddenly default tomorrow. They should be able to withstand it. We're very concerned about the high-yield bond market, and this is my long-winded answer to your question. There really haven't been any cracks yet. One thing that happens usually when the Fed tightens the way they have, and as we get closer to a recession, is you start to see the risk premium for risky companies, for risky company bonds, rise. Right? If there's a junky company out there that has very low credit ratings and has volatile cash flows, usually we investors demand higher yields to lend to them. That hasn't really happened yet. When you look at the high yield market, spreads are still close to a long-term average in an environment that we think is very risky. So that's part of the reasons why we're pretty cautious on high yield bonds today. Just we don't think investors are getting compensated well.
We'll go to Kimberly, then one more.
Quick question, can you describe yield to worst and why it's an important metric for bond investors to understand?
Yeah. You seem like a plant. These are great educational questions. Do you work here? So yield to worst. So I mentioned before, I'm going to keep harping on this, that the bond market's really complex, right? It's really tough to understand. And there's a lot of yield calculations out there. There's current yield, yield to maturity, yield to call, and yield to worst. So the main yield calculation is yield to maturity. That's what's my annualized yield going to be if I hold that bond to maturity. Not all. Some bonds are callable, meaning the issuer can redeem them before the stated maturity date. So you also have a yield to call, which can be different from the yield to maturity depending on call price, the call date, and the price you purchased the bond at. The yield to worst is the worst of those two. So if you buy it, here's your worst case scenario, assuming you're getting your money back from the issuer. A worst case scenario would be a default and you don't get your money back. But in the case of a non-default, this is the lower yield I'm going to get based on either holding to maturity or any calls that are out there.
We usually look at yield to worst for our clients in terms of kind of a worst case scenario. And think about that and hopefully better things will happen.
Yes.
Maybe one last question. Does anyone? I see John Marcus over there.
There seems to have been a little bit more noise coming from the Fed and Treasury about potentially going down the path of yield curve control. If the Fed does decide to do that, does that change the outlook for price appreciation for intermediate and long-term bonds anyway, rather than just straight rate cuts as they've done since 2008?
So yield curve control is something that Japan is currently doing, where it's one of their many tools where they're not just buying bonds in the secondary market, they buy them to target a specific yield. I don't think there's much talk about that happening in the US, at least right now. If they were to do that, it's a form of easing, so that would be a good thing for bonds. But even if they don't do that, I think the main point is once we get past this tightening cycle and then to the pause phase, the next logical step is some sort of easing. So whether that's rate cuts, whether it's quantitative easing, or whether it's some sort of yield curve control, the result would likely be lower yields and higher bond prices. But we're not expecting any yield curve control in the US, at least not anytime soon.
So, I want to thank Collin. I got to tell you, I've talked to many a bond manager over the last 22 years. This guy's a rock star, okay? So he makes bonds understandable and interesting, so I got to thank you.
Did I make them sexy, though?
Let's not go that far. I think interesting is probably as good as we can get. Again, once again, Schwab has been a partner of ours from the day we basically opened our doors. Christine and I, and they've embraced us when we were managing nothing, right? And they took a chance on us and they've given us outstanding support over a number of years. Lizanne, Jeff, you, and many others over at Schwab. And to do what we do, we have many strategic partners. And it's a matter of pulling all those partners together to try to execute and do the best we can on their behalf. So we do our best. We're really thankful that you all came out tonight. I know there's plenty of other things you could be doing. But I think we're going to continue to have some food naps. Do we have it, Meera? Anything left? Desserts? Desserts, maybe some wine still. Thank you all for coming. We enjoy doing these events. You can tell we're having as good a time, hopefully, as you are. We love gathering information, getting different thoughts and ideas, and it's been a real pleasure. So enjoy the rest of the evening.